The second half is going to be to fulfill the promise I made last week and look at not just the 7 principles for long-term investors that we covered last week, but to add in 3 more that are germane to me. So what I covered last week is really at the heart of Motley Fool Stock Advisor and a lot of Motley Fool philosophy. But the 3 I'm going to cover this week are much more stylistic and much more my kind of thing. My brother might not agree. Other staffers at the Motley Fool might not look for these things. These are my 3 additional personal principles, not so very different from the ones I just read that were yours. Now I'm giving you some of mine. I have 3, and for each of these, I'm going to give some examples of companies and stocks that I think fit within these. All right, let's get started. Number 1, invest in companies with unquantifiable greatness, a secret sauce that gives them an edge. Now, for consumer-facing businesses, that means finding products that are sticky, products that fasten themselves to people's daily lives. And me and my team at Stock Advisor, we often ask, how would consumers react if someone took that company off the face of the earth tomorrow? In fact, I did that in one of my early podcasts for Rule Breaker Investing. I call it the snap test. Snap your fingers. If you snapped your fingers and the company you're looking at disappeared instantly upon snapping your fingers, the next morning, how many people would notice? How many people would care? And if you invest like I do, you want a lot of people to notice. You want a lot of people to be pretty upset that you snapped your fingers. You shouldn't have done that. And that kind of speaks to the greatness aspect of unquantifiable greatness, that phrase that I'm going to double underline for this point number 1. Let's talk briefly about unquantifiable. What does that mean? Well, that also harkens to an earlier point made in Rule Breaker Investing. I hope all of you have gone back and listened to all 18 or 19 of our podcasts so far, and listen to them again if you need to, or maybe especially those first 5 or 6, which are kind of formative stuff. But I talked then about optionality, about how important it is for me to think, to like the multiplicitude of possibilities that some of our companies, some of my favorite companies have. I love the companies that have 30 possible futures, not just 1. That's the unquantifiable part. That's what confounds the stock market, because when a company has that kind of possibility, it's really hard to put a number on that, or especially highly numerically inclined investors, people who use screens to look for certain ratios and just pick stocks based on certain numbers. When you can't quantify things that are important, that confounds that style of investing. The computers with their algorithms have a hard time processing unquantifiable things, which is why I think as investors we have special advantages when we find such companies. I'll give a couple quick examples. I think Zillow is a company that a lot of people would miss. Now, it's not universally known, but it is the company that puts property values on almost everything in the United States of America today. So you can look at your house, you can click your block, look around your neighborhood. Increasingly, it's a tool used by real estate professionals to do their business and advertise themselves there. But, there's a lot of value. It's really hard to think about all the things Zillow can do with that, the businesses that they can enter into over the course of time. At early days, people thought, hey, you know what? Zillow's actually trying to put those realtors out of business. They're just going to start saying, sell your house directly online, just like you sell a product on eBay. Why would you pay 6% sales commission to a realtor? And it's ended up that has not been the case. Zillow has not really put realtors out of business. In fact, it's increasingly a best friend to many realtors, but it does have the possibility of doing that in some contexts in future. That's just one example of what Zillow could do. Another company with unquantifiable greatness, and it's hard for me to talk about this one just because it's a stock that has performed so poorly, especially in 2015. It's been a loser stock pick of mine, but I still like the company, and I think it passes the snap test. That is, if we snapped our fingers right now and Twitter disappeared overnight, I think a lot of people would notice, and I think a lot of people would care. So, and it's very unquantifiable, and that's part of Twitter's problem right now, is that people are asking, well, how are they going to make money? Or what are the ways they're going to make money? Or lots of people are using it, but how do they really monetize that with sufficient ad revenue? And a lot of those questions remain, and even management questions, which have been recently solved. But so it's an example of a company that I'm talking about, but I wish every one of our companies were winners, and every one of my principles led to a 100% success rate. But the truth is, we're all venture capitalists, a point I'll be getting to very shortly. At least that's how I think about things. We're going to get it wrong from time to time. That's the nature of the game. So we'll see with Twitter. I like Twitter a lot here at this low depressed price, though. All right, principle number 2, again, 2 of 3 this week. Choose companies that will benefit from undeniable long-term trends. You know, a great example in our lifetimes has certainly been the internet. As it came to the earth, as it started to rage, this amazing new beast shaking the planet, the internet was clearly, undeniably a long-term trend, creating all kinds of possibilities as it was adopted to disrupt existing brick-and-mortar retail, to enable quicker payment, to allow people to connect with friends. There are so many aspects, of course, to the internet. Undeniable long-term trend. Undeniable is a key word. There was no question in my mind, I hope in yours, that the internet was and is here to stay. I think next one coming down the pipe, I love it when new media are created. Virtual reality. It's not really out there yet, but there is no question in my mind that it is a major new medium that will greatly change the world over the course of the next several decades and counting. And so we're still early on, and there's not a lot of obvious plays here for investors. I mean, a company like Facebook acquiring Oculus is one example, paying 9 figures to buy early stage technology. Facebook has made it clear. Mark Zuckerberg agrees with us here on Rule Breaker Investing. So I think it's undeniable. And I think it's a long-term trend, so we should be looking at these kinds of things. I'll just give 2 more quick examples of, to me, undeniable long-term trends. One is genomics, that we're going to get better and better at figuring out your genome and mine and learning from that, creating personalized, customized solutions that work for you, that heal you, that improve your life, that are pertinent only to you because of your unique DNA. And so, to me, a company like Illumina, which has been a wonderful performer for us in Motley Fool Stock Advisor now for some years, leads, since it makes the machines that do a lot of that genomic decoding. But genomics is a big thing like the internet. There are a lot of players, and there will be a lot of beneficiaries, and especially you and me, because we as individuals will benefit. There will be some lack of benefit, some loss of privacy, some questions about if you have a really bad gene and I'm your insurer, what does that mean for our relationship together? These things are not easy to talk about or understand or predict exactly how it'll play out, but undeniably, this is a long-term trend and one that is net a great trend. And another one is the so-called, I kind of don't like this buzzword, but we'll go with it anyway, Internet of Things. There's just no doubt that we're putting chips in everything today. It seems like you might even have one in your ladder or in your light bulb. And we're using that to allow our devices to work more in concert with each other. And so, for me, an early example is just driving down the highway, and in the Washington, D.C. area anyway, we have the Easy Pass. And this is just, rather than stop at the toll booth, you just blow right through. I bet you have this in your area. This is not new technology anymore, but there's basically a chip you have in your car, and it blows by the toll booth that has a chip, and it just ka-ching charges, and it adds convenience to your life. It adds steady source of revenue for your local government. Undeniable long-term trend, the Internet of Things, and companies like Skyworks Solutions, which we have in Rule Breakers, or Sierra Wireless, which we have in Stock Advisor. These are all companies that will benefit from that. Are they all winners? Will they be? No. There will be a lot of losers, but tend to favor companies that are in undeniable long-term trends. Finally this week, number 3, get in early on a great business and don't haggle on the price. Boy, have I learned this one over and over again. In most of my best investment moves, I was recommending a stock that had already done really well. This is hard for a lot of people because we hear buy low, sell high. So we think we need to look for things that are beaten down or near their 52-week low. But when I recommended Amazon.com in 1997, perhaps my longest term recommendation at this point, still in there. Our cost is $3.21. Amazon had doubled in the 6 weeks leading up to that pick. It was hard to make that pick at the time. But I didn't haggle on price. AOL, certainly one of the great stocks that I'll ever pick, no longer a big world leader as it was in the 1990s, but in the 1990s, that was the decade that America came online, benefiting from an undeniable long-term trend. And AOL, I had watched as a user go public in around 1992, and go up 4 times in value with me just sitting there on my hands going, it's up again. I still haven't bought it. I use this. I believe in this, but now it's done so well. And finally I decided, you know what? I'm just going to go ahead now and buy. And the company went on from that point, again, having quadrupled in the 2 years that I was watching it with increasing frustration. It went on from there to go up over 100 times in value further over the next 7 years. So get in early and don't haggle on price. Don't haggle on price to me means act like a venture capitalist. Not a lot of venture capitalists sit there and go, what's the price to earnings ratio of this? And what are some of the other traditional valuation metrics that people would apply that I'm going to apply to this early stage situation? No, that's not how venture capitalists think. They basically ask things like, what is the total addressable market of this? What could this grow up into? That's why I prefer numbers like market capitalization, as opposed to price to earnings ratios. I don't want to spend a lot of time haggling on price. Again, if we're getting in early, the price probably at that point almost doesn't matter. And certainly looking back at the Amazon.com cost basis I mentioned, I barely even remember it. It doesn't matter much to me. Instead, it's that we found and that we bought Amazon.com, or maybe for you, Apple. Or how about Pixar in 2003? Pixar always looked expensive, but was a great company. And, of course, eventually bought out by Disney. But these are all examples where we got in early and we didn't haggle on price.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about rule breaker investing at rbi.fool.com.